Guys, I've been doing a lot of videos on how to buy bonds and CDs and all of that. And that's mostly because interest rates have jumped up in the last year to the levels of 5% or so. But just realize that even with the CPI coming down, we are still at negative real interest rates. So even if you're getting 5% on your CD or Treasury bill, you are still losing money every year because of inflation. So I don't want people to think of bonds as really long-term vehicles for them to put all their money in, because as we'll see, historically, it is better to be in stocks actually. And so I'm going to show that with some historical data showing the mix between stocks and bonds, anywhere from 100% stocks and 0% bonds, all the way up to 100% bonds and 0% stocks, and see how they fared over a long period of time. So let's go take a look at that. So this article on Zero Hedge is why 60/40, visualizing 90 years of stock and bond portfolio performance. So after last year's Federal Reserve hiking interest rates the fastest speed in 40 years, it was actually the first time in decades that both stocks and bonds posted negative annual investment returns in tandem. And over 4 decades, this only happened 2.4% of the time across any 12-month rolling period. And so Visual Capitalist has this nice infographic using Vanguard's data. And so these are the annual returns from 1926 to 2019. And it shows the best and worst performance on different stock bond allocations. So here the first line is 0% stocks, 100% bonds. And so the worst return for this allocation from 1926 to 2019 is minus 8.1% was the worst, 32.6% was the best, and the average was a 5.3% return per year over this period, right? So then it goes down to different allocations. Right now, 10% stocks, 90% bonds. Similar, the worst year was minus 8.2, the best year was 31.2, and the average is 6%. And so if we go all the way to the other extreme of 100% stocks and 0% bonds, we get the worst return was minus 43.1%, the best return 54.2%, and the average of 10.3%. And here they say since 1926, bonds have posted negative annual returns 15% of the time, or about 1 out of every 7 years. And these are the percent of years with negative returns. And so if you just had stocks, 28% of the time, or 1 in every 3.5 years or so, stocks have a negative return, whereas bonds only 15% of the time. And if you have a 60-40 split, 60% stocks, 40% bonds, only about 23% of the time do you have years with negative returns. Now, depending on your risk tolerance and goals, different people have different combinations of stock and bond percentages. One rule of thumb that some advisors say is take 100 and subtract your age from it, and that's how much stocks you should have. So the younger you are, if you're 20 years old, 100 minus 20 is 80% stocks, let's say. And if you're 80 years old, 100 minus 80 is 20%, so you should only be 20% stocks and 80% bonds, something along those lines. But looking at these returns here, you see that the 60% stocks, 40% bonds is kind of a nice middle ground here for a lot of people. And so this portfolio had its worst year in 1931 as the US economy faced a banking crisis and the money supply fell about 30% between 1930 and 1933. This combination had a 26.6% loss, right? But its best year was 36.7%, and the average of this 60-40 portfolio was about 8.8% annually. And so compared to the 100% stocks, 0% bonds, where the average return is 10.3%, it's only a 1.5 percentage point difference, but a 3.5 percentage point difference than just the 100% bond portfolio. And it says, while stocks are more volatile than bonds, they have averaged roughly 7% in inflation adjusted returns. And that a $100 investment in 1926 in equities with dividends reinvested would have soared to over 877,000 by 2019. Now, this probably doesn't include taxes as well on the dividends or whatever, selling stocks and buying stocks. Now, to show you what an anomaly 2022 was, here is the returns of stocks and bonds, right? So bonds is on the y-axis and stocks is on the x-axis. So anything above this line is a positive return for bonds, and anything to the left of this line is a negative return for stocks, right? So in years when the stock market had really bad returns, 2002 was what, minus 22% or so. 2008 was like minus 36% or so. Bonds were still positive on the year. So here bonds are up 5% or so. Here they're up 10% or so. So that helps the losses in your stocks on those years usually. And so you see, as stocks are negative here or even positive here, bonds are generally positive all of these years. And here even a lot, 1982, 1985, 1995. And so only one other year, 1969, where stocks and bonds were actually negative, and not by much. We're talking what, 3 or 4% maybe over here, bonds and stocks in 1969. Whereas 2022, we had stocks all the way here negative 18%, and bonds all the way down here negative 12%, both in the same year. So hopefully this is a huge outlier year and we don't see a lot more of these in the future. Now, this data from NYU shows not only stocks and bonds, but also corporate bonds, real estate, and gold as well from 1928 until 2022. So this is really interesting as it shows the return at the end of the year for the year, right? So right before the crash, 1928, S&P 500, including dividends, was up almost 44%. 3-month T-bill up 3%. U.S. Treasury bond 0.84%. BAA corporate bond 3.2%. Real estate 1.49%. Gold 0.1%. Now this table over here shows what the value of each of these categories would be if you invested $100 at the start of 1928 and let it ride all the way till 2023, right? So your S&P 500 would already be up to 143 in the first year because of this rise. And 3-month T-bill, gold up very little. And so as we go through the years, you see that the stock market crash brings your $100 down to as low as $50, whereas everything else does relatively well except for real estate. But as we go on in the years, by 1935, your $100 is above water again, although it drops over here, drops over here. But really, after 1942, it doesn't look back, and so do these other asset classes, right? But as you go on, right, 1970, $4,000 versus 245, 349, 726, 211 for gold. And so the compounding of stock prices and dividends just goes nuts, while the rest of these don't do that great. And so the end result at the end of 2022 is your $100 is $624,000. The T-bill is $2,100. The Treasury bond is $7,000. The corporate bond is $46,000. The real estate is $5,000, and the gold is $8,800. Now you're probably thinking, okay, well, I don't really have 100 years to invest in stocks, and who knows what's going to happen in the next 100 years. But here is another interesting chart to show you. If you invest $1,000 in the US stock market at any 10-year period here, how much you would have nominally and inflation adjusted by December 31st, 2022. So in other words, if you invested $1,000 on January 3rd, 1871, by the end of 2022, you would have $584 million nominal, or inflation adjusted, almost 23 million. If you invested that same $1,000 over here in 1969, by 2023, it would be worth 182,000 nominally and 23,000 inflation adjusted. Or if you just invested December 31st, 2009, $1,000, that $1,000 by the end of 2022, 14 years later, would be worth $4,400 approximately, or about $3,200 inflation adjusted. Still pretty good returns, especially compared to bonds or even gold or even real estate. So guys, why am I telling you this now after I've been talking about bonds and CDs and gold and silver and all of this? Am I now shilling for the big brokerage houses or Goldman Sachs or something to buy stocks? Yeah, kind of, when you look at the actual numbers. And so all these videos I do saying buy bonds and CDs and all of this because of these rates, or have some money in gold and silver, it's kind of like a temporary situation waiting for stocks to get to a better valuation, because in the long run, you do a lot better with stocks, and especially dividend stocks and that kind of thing. It's not because gold is worthless or anything like that. Gold keeps its value. It doesn't do anything, right? So if you bought five $20 gold pieces back in that 1926 or whatever, that $100, that would only be worth about 5 times the 1 ounce of gold. The $20 gold piece was a little bit less than an ounce, but let's say it's an ounce. You got $10,000 today versus a lot more by buying stocks and dividend stocks in particular. Now, I realize a lot of it has to do with not because stocks are doing so well, but because they're priced in US dollars, and the value of a US dollar is going down so much, especially after we got off the gold standard in 1971 with Richard Nixon. So don't invest based on what the right thing to do is, and that we should go back to gold and silver as real money and all of that. That's not going to happen anytime soon or at all. So invest based on what the reality is today. And that reality is that stocks do a lot better over the long term compared to other things like bonds, real estate, and even gold. Now, that doesn't mean you shouldn't sit out the stock market if you think stocks are overpriced, or it doesn't mean you shouldn't be in bonds or CDs or treasury bills while you wait that out to get some income. But the main goal should be find a spot where stocks are reasonable or cheap and get back in and sit on them for a long period of time, and you will make out in the long run. Hope you like this one. Thanks for watching, guys.